Welcome once again to White Swan Finance and the second episode of Dumb Money Diaries. In this episode, we are going to be exploring fair value gaps, order blocks, and why smart money concepts are just. The software that I use is by ATAS, and if you want to give them a go for free, there is a link in the description below. You can use them for stocks, futures, and crypto. Okay, so I'm sure there are some SMC lover boys already preparing to write in the comments all about why I'm wrong and how SMC is the greatest thing and I'm just brainwashed by institutions. But I did quite a lot of research into this and even risked my own sanity by watching many of the videos and guides out there. Now, I don't mean to hate on these people, but from watching these and more, I heard some of the most backwards and nonsense analysis I've ever heard in my life. Some even categorized price action as order flow. So before we're going to go any further into this, let's clear this up. This is a candlestick chart showing us price action. It is the result of order flow. If you cannot see the orders like this, you are not watching order flow. You are just watching price. This is order flow. This is not. So now on to the so-called fair value gap. We will begin with the common understanding that seems to be accepted by all, which is that they form between two candles and are the result of an imbalance or inefficiency in the market, and that if price returns to them, they can be used as an area where we can blindly enter a limit order and pray that we make profit. Then, we can consider ourselves a market wizard if we do make profit, and if we don't, we can just say that we used the wrong fair value gap. And no, seriously, this seems to be the common way to lie to yourself and others about your appalling trading. I saw many examples of this, and some even explain how to use the right ones versus wrong ones. So if after you pay for a mentorship from a guy who's never traded professionally, and you take a bad trade based on their teaching, all they will do is say to you, "Oh, it's because you used the wrong one." Then they will show you in hindsight the one that you should have used, but they will never tell you exactly why they knew that was the one to use, almost as if they themselves didn't know either. Sound familiar? Well, the forums, discords, and comment sections and reviews that I looked at when researching this, it certainly should sound familiar to a lot of you. Now, I was going to spend this video just slagging off every trader that uses these techniques and for some reason thinks that they are how professionals trade, but I thought I would be more encouraging than that. So I decided what we would do is analyze these methods using real order flow, because actually I think you will find this quite interesting. So here's an example of a fair value gap that did act as resistance when price returned to it. But why did it work? Let's zoom in closer and look at the real order flow together. As you can see, we have multiple imbalances and our highest delta node here. If you want to know more about imbalances, I covered them in a previous video regarding footprint charts, and I have a more detailed video coming up on them in the future. Now, from this example, it appears that the concept of a fair value gap might just be a way to try and guess where multiple imbalances or a stacked imbalance occurred. But we should certainly look further into this to confirm our hypothesis. I actually had a few theories and that I'd guessed the so-called fair value gap was based upon, so let's keep looking a little bit. Here is a chart where we have multiple fair value gaps created in the down move. A common finding actually, as the idea on drawing these is so loose, it includes any three candles where the first and last don't have overlapping wicks, and the space between is then therefore our magical gap. So it's occurrences like this where traders have the issue of which one to use. Now, my answer to that would be to forget strategies like this entirely, but for the sake of fully showing you why, we will continue. Zooming in on this first one, we can see that there are no large imbalances or stacked imbalance. So then, could we have predicted price turning here? Well, perhaps we would have used the delta node as an entry point, or the high volume nodes like we learnt about previously. This would then have been an area we could have looked for an educated entry, not an entry from a random box. Let's look at the second place, if there is anything significant in the order flow there. Again, no real imbalances, which is odd seeing as the fair value gap is supposed to show us areas of imbalances in the market, but there is a lot of volume and delta printed, and the strangest thing, we actually reversed at this area of high volume. I actually looked at a lot of these, from ES and NQ to soybeans and even some stocks. I checked a wide variety and I feel confident in telling you they are useless. I truly found no good connection or reliable way to forecast these in the market. Sometimes you will be lucky and there will be an imbalance or volume cluster inside the box you draw, and sometimes there won't be. So they're definitely not reliable. Remember, by definition, they show us imbalances in the market. So tell me why we commonly don't see any when we draw a box between two candles. I guess we're just using the wrong ones, right? But then, I found this thing called an inverse fair value gap, which added even more nonsense to the mix. In case you aren't familiar, this is where you drew a fair value gap, most likely took a loss, but now you are going to use the same random area to take a second trade, in the hopes that this time it will be a success. It would make sense if the area you drew actually had some significance, but as you've just seen, they are random enough that you will have some wins and some losses. But the problem is, most retail traders will assign much more weight to the times that they were successful and therefore think that there is a way to make them more accurate. Much in the same way that you will hear retail traders saying, oh, this top is strong because price has tested it many times, but that's just because they're trying to convince themselves that their short trade will work out. Or if they were long, they will say, oh, price is testing it so much, it's surely going to break soon, and I will hold my long position even if price sells off. You see, you can convince yourself of anything. And this is a major problem for retail traders, especially given that many trading channels and so say mentors seem to actually contradict one another on the very same subject. This is why order flow is superior. There is no argument that only one contract traded here. There's no way to misinterpret that there were high volume nodes here and that the delta was negative 100. The problem with smart money and most technical analysis is that it is so open to interpretation. Still don't believe me? Well, let's take a look at another part of smart money concepts, which is an order block. Certainly nowhere to hide with this. If an order block is real, we will be able to see it in the order flow. The first problem is defining one, as there seem to be many different descriptions out there. The most simple that I found stated that an order block represents an area in the chart where supply or demand imbalance occurred. Well, that sure is detailed. I found this as well, which states, order blocks are the footprints left by the market when an impulsive move occurs. An order block is the last candle before the strong move that creates an imbalance in the market. So equipped with this revolutionary trading ideology, let's look at some charts. Here is the last candle before price reversed, just like in the definitions screenshot I just showed you. Now, if you watched my previous video on volume, you will recognize this. We have high volume nodes and a continuous point of control signaling to us that there may well be support here in the future. And would you look at that? This is where price reacted to when we returned to it. Nothing to do at all with our so-called order block. In fact, if we look at the volume inside the order block candle, it isn't even significant. It's lower than the previous, it is higher than the candle that made the low, and we do have a B-shaped profile. But let's check the bid-ask footprint and see about the actual orders, seeing as that's what it's meant to find us. Well, certainly no big orders came through. The point of control indicates that we might be seeing absorption, but not enough that it would convince me of a reversal yet. So did this order block find us a place where we had an imbalance reversal or super high volume or anything significant? Not really. Let's search for one more. Here it is. This time I want you to look and see if you can find anything significant inside the order block candle. Here is the volume and here is the bid-ask footprint. Do you see what the order block is showing us? Remember, you are looking only inside the order block, not at what happened afterwards. If your answer is no, then you're right, because it isn't showing us anything at all, really. Just in case, if you're wondering, did price react to this order block at a later time? The answer is also no. So maybe I just don't understand. Maybe I should blindly believe in them and then they would start to work for me. Or maybe I should invest into a mentorship so that I can learn them correctly. Well, I certainly won't be doing that, and you shouldn't be either. But perhaps in the future I will join some groups and ask them for full details on why they believe in these things and how they know there were large orders somewhere without actually being able to see the orders. Let's see, maybe it would make for a good follow-on to this episode. Lastly, I want to talk about the whole thing about calling the market. Quite frankly, based on how a lot of these videos do it, I'm truly staggered that no one else can see it because it is blindingly obvious. I'm not going to state the exact channels, but there are quite a few of them out there, and they all do it in the same way, and they do it like this. If price finds support, then we will be looking for it to reach this high. If it doesn't, we are looking for price to test these lows. Then, later on, they will post a screenshot or video like this, and they will say, see, I told you it was going to go to this level. And then, for some reason, everyone in the comments is awestruck and says how clever they are. How did they know it? I'm truly staggered by people's belief in them. They basically just said, if price doesn't go up, then price will go down. And then, if the price ranges for a while, they blame the market and say, oh, it's being manipulated, but it will reach one of our targets soon. I mean, come on. Seriously, people, what are you doing believing this? Quite frankly, if you're into it and defending smart money concepts and think that somehow they're going to make you the world's greatest trader, able to top the leaderboards of FTMO or Robin's World Cup, then carry on. You frankly deserve to lose. You deserve to constantly guess and be fooled by charlatans. I seriously do not care. But what I do care about is the new traders that are scammed into believing that this is the secret success to trading, or the traders that are still struggling to become profitable and are told that it's their psychology when actually it's the misguided trading analysis that they are taught and that they believe in. But for now, that is the end of this video. Please subscribe, like, and comment your thoughts on smart money concepts. And if you want more in the future, I can expand about the mystical algorithm and possibly one of the only parts of SMC that does actually have any grounding. But in the next video, we will be looking at highs and lows and how we can determine strong versus weak ones using order flow. Until then, bye for now.